Good afternoon, ladies and gentlemen. Thank you so much for being with us. Enjoying 10-year celebration of Quantera Global. Fourth webinar today in the webinar series around our festivity. Today we welcome United Kingdom colleague Arnas Laurynas, who is presenting out of London. So welcome so much, Arnas.
Hi, Rudolf. Hi, everybody.
What we are presenting today, basically Arnas will be informing us of the latest developments in the UK in a few minutes' time. A quick run about Quantera Global and me, perhaps for the ones who are not that familiar with Quantera Global or me yet. Quantera Global, well, has been founded 10 years ago and is currently the largest independent service provider in transfer pricing. In the Netherlands, we consist of some 30 people altogether, providing transfer pricing consultancy work and also software through Coperitas. And together with Arnas and other colleagues, we may be serving you in some 40-50 countries around the world. We do like our job, we do like our transfer pricing area, and there's more to discover as a sneak preview for Arnas to come. So welcome all today, and let's start our presentation. Perhaps Arnas, you take over and introduce yourself and the program of today.
Thank you, Rudolf. Yes, a few words about myself. I'm managing director representing Quantera Global in the UK. I've been doing this transfer pricing and international tax and related areas for over 15 years. Coincidentally, it's my 10th year in the UK and 6th year in Quantera Global family. I'm very happy to be here and present this webinar together with Rudolf. One small sneak preview of some additional announcements next week, and this is a nice opportunity to do a first mention of it publicly. My team and I are launching a new brand, IVC Consulting, which you can notice a small logo next to my name on the slide. IVC Consulting, iValue Consulting, will be a firm within Quantera Global network, within the Quantera Global family, but under its own distinctive brand. We're very happy to have been nurtured under the Quantera Global brand for the last 6 years, but the dream and the goal is to have slightly broader spectrum of services, not just transfer pricing, but going into some elements of automation, Excel modeling, some valuation work, some touching some other legal and international tax issues. Follow the announcements to come. But again, I would just re-emphasize the big thank you for Rudolf and the team at Quantera Global to fostering my team and my practice for the last 6 years. And we're definitely remain strongly committed to Quantera Global as a network, as an independent alliance firm. So a bit about myself and the new venture starting next week, but the rest remains the same, and I'm happy to present here on behalf of Quantera Global about the UK in the last 10 years. So maybe we can look at the next slide, Rudolf. Thank you. So this will not be a technical session. I don't know if you're sighing it's a sigh of relief from your side, or there's some tax geeks on the webinar who are switching off as I say this. But the idea is to maybe look at the themes and the trends in UK as a transfer pricing jurisdiction. What themes have been kind of shaped the HMRC that it operates now, what legislation has been meaningful and impactful in the way they operate. And hopefully you'll find that insightful. The elements of HMRC capacity and the change, looking at how UK adopted the international tax framework. I mean, definitely the policy has been shaped by Brexit over the last 7 years now, maybe even a few more in preparation to that. And then also a bit of fresh off the press in terms of spring budget announcements a few days ago, and we can discuss the new transfer pricing documentation requirements in UK, what the corporate tax rate increase means, some more technical elements of Pillar 2 and some additional powers HMRC had to introduce in order to facilitate the transfer pricing documentation requirements. So in short, that's going to be it. Hopefully, I will not keep you for the whole hour. I'll try to make my presentation as brief as possible, and leave some time for questions as well at the end. I guess we can move forward. So if we're looking at the last decade, and as I said, this was kind of the 10 years ago, I came to London to work in one of the big four accountancy firms, already established, and actually have already worked with Rudolf in Netherlands in the year before that arrival. HMRC was one of the most business-friendly jurisdictions or tax authorities. There was definitely emphasis in cooperation of the taxpayer, as opposed to being kind of adversarial and very aggressive. So let's see how the 10 years have changed that. Let's look at the next slide. And this is a very interesting one. The statistics on the transfer pricing yield, namely how much additional tax transfer pricing related audit actions have brought into the budget. As you can see, there's definitely a trend upwards for the last 10 years. In total, the Treasury has gained around 14+ billion of pounds just from the transfer pricing audits, which is a huge amount. And the last year, about 10% of that number was last year. And I would imagine it doesn't stop there. Naturally, that means a lot more emphasis through the period on the audit, right? And you'll also see that there's new legislation. I'll talk about the new legislation that was introduced. Diverted profit tax was a very prominent one, and it was introduced in 2015-16. And as you can see, the amounts really picked up from there, almost doubled, and in some cases even more. It just allows HMRC not only approach transfer pricing, which is complex. The arguments on how to interpret the rules, who is right, really kind of can take a long time and doesn't necessarily result in let's say, quote unquote positive yield from the tax authorities' actions. Things like diverted profit tax really put the onus on the taxpayer to prove that they're not kind of wrong. And a lot of these big cases are being settled through the threat of diverted profit tax. Another one which might worth mentioning, which legislation of diverted profit compliance facility. The fancy name means that HMRC is able to issue a nudge letters or warning letters to a lot of multinationals that are perceived to be in the wrong on the transfer pricing and to some extent diverted profit issues, diverted profit tax issues. And that nudge letter requires the taxpayer, either submit a correction or face an imminent and most probably unavoidable tax audit on the issues that HMRC might have picked up. So those kind of tools allowed really to to continuously get more and more in tax revenues from these tax audits. And as it is a successful strategy, as you can see on the graph, most probably that is bound to continue as well. Then we can look a bit on the next slide. So how are they able to do a lot more? And one of the ways how to do a lot more is hire more people. So we can talk a bit about the way HMRC is doing the digitalization, investment in the IT systems and things like that. But most notably, the number of people that are working on transfer pricing related issues has grown significantly. The data doesn't go a lot more than that, but effectively in 2017 they still were reporting a transfer pricing team and a diverted profit tax team. After 2017 it was merged, and then there were increasingly some kind of professionals who dealt with debt, things like that. They were merged into a big unit that was dealing with transfer pricing related issues. And you know, as you've seen, it wasn't just adding people, but they actually were working hard to challenge the taxpayers and be successfully kind of settle or claim some big amounts to the treasury. Let's go to the next slide. So if we have a lot more people, have they spent more in terms of more time in terms of the trying to give certainty and assurance to the taxpayers, maybe in terms of, in this case, APAs? Have they kind of managed to be business friendly as they used to be? The answer is not really. They might have spent more time, but on less cases. You can see on the right the rise of the average time to reach an agreement, APA agreement, went from roughly 20 months to 60, almost 60 months. And that's a huge gap. Again, as being part of a couple of these processes, it seems that the people have been extremely pressed, and maybe there's not enough resource from that increasing number of people to do the APAs, as opposed to diverted profit tax and audits and things like that. And that is quite frustrating. But one additional thing, and I'm sure that if you look at the on the left side and the dashed line dropping from 2014 to 2017 in applications made to the year, and I remember specifically a lot of conversations with clients during that period of time, because the approach from HMRC agreeing an APA application turned from, we have a transfer pricing issues, we have to agree on transfer pricing issue, and kind of we can go our own ways with the 3 to 5 year certainty from both sides. But actually it became, well, we might agree on the transfer pricing issues, that's not at stake, but can we also look at a number of other tax and transfer pricing related aspects that the taxpayer has to be providing information, agreeing, showing evidence to a point where you literally during the APA you're presenting the emails of the employees of the companies in order to ensure that the unallowable purpose test is complied with. Things like that really extended the time, and that's what we see on the increase in the time required to agree an AP agreement. But also from the taxpayer's point of view, and I've definitely advised my clients similar way. If you have some doubt about the position you have in transfer pricing, it's no longer super kind of beneficial to go for an APA, because you'll spend the next 5 years trying to convince that not the transfer pricing is correct, but all the other issues are correct. And some clients were not comfortable with that, and some clients didn't want to waste management time to do these rigorous checks on things that are not transfer pricing related. So that's kind of what we see in the in these graphs as well. If we move to the next one, we'll also see the next slide, please.
Doesn't seem to work, awkwardly enough.
Yeah. Well, as you're trying to sort it out, I can kind of do a preview of what will be discussed. There's an element, a very specific APA type in UK, which is called Advanced Capitalization Agreement, ATCA for short, and it's a variation of APA for financial transactions, right? And it has been successfully introduced quite a while ago. And I remember, and you can straight away look at the graph on the left, and the peak during the 14, 15, 16 of agreed ATCAs, and I've worked on a few as well. It was the standard way of companies getting assurances on their shareholder debt. I worked a lot at the time. I was working on a lot of mergers and acquisitions, a lot of acquisition financing. Every single bigger transaction was, let's say, stamped by HMRC, but stamped quite in a rigorous way. That there would be a bit of back and forth, but it would be a very constructive back and forth. And look what happened since, from 2015, 16, the agreements that were in force, the ATCAs that were agreed up until that point have significantly been reduced, and the time taking, and one of the elements of the benefits of the ATCA versus APA was that you can agree it in 10 months, and it was much shorter. Parties on both sides understood the financial transactions quite well. HMRC, I could be very clear that HMRC understood the financial transactions. They could have discussed kind of borrowers' credit worthiness, the capital structure, a lot of terms that only afterwards were introduced in OECD guidelines through Chapter 10. So it was quite productive, constructive discussions up until the point where the same happened to ATCAs. What I noted on the APAs, other issues became the central point of the discussions, and it went from agreeing something in 10 months, which clients saw as a huge benefit and a good service from transfer price from tax authorities' point of view, to a point where you have to spend almost 4 years on something that should be fairly simple. Again, we can move on. So the next, if it's not APAs and it's not kind of negotiations to agree in the future, what are majority of people in transfer pricing team and HMRC are doing? And they are doing a lot more complex audits, right? So what also could be felt that HMRC, they always have this ROE, return on investment mentality on any audit action. And sometimes it means that for the smaller taxpayers, you don't take it as a very strong advice, but the smaller taxpayers can get away with a bit more, because the HMRC will never spend enormous resources to prove something that is complex but small in scale. So there was a lot more big ticket items, big audits, but as the audits are bigger, more complex, the time in order to kind of conclude on the inquiry also increased from at the lowest point from 22 months to last year being 34 months. And I guess we can move to the next slide. It's not all bad. So one of the things that actually we as transfer pricing tax professionals have to indicate, HMRC is very good at negotiating things internationally. And that means that they have, even though they kind of approach big taxpayers and with this big maybe challenges and material challenges, they're able to also involve the other side, side of the audit in terms of other jurisdictions like Germany, France, or even ones in Asia and Americas and things like that, quite well, right? So they have started a lot more MAP cases. They have concluded and resolved a lot more MAP cases, and they have maintained that quite stable kind of 20 to 30 month period, which I think is a good achievement, even though you have for instance, EU arbitration cutting off the arbitration at 2 years. Actually, in a lot of cases, we see that it can be prolonged. So HMRC has done a good job to actually stick to that period, and that's something to be happy about, right? So at least you don't get double taxation. It is resolved between the tax authorities of the companies the transaction are being concluded or executed in. So this is kind of going through the numbers and trying to make sense of the numbers and seeing the themes that brings us to the last, to kind of this year and how HMRC is looking. HMRC is looking a lot more aggressive. They have a lot more powers. They have a lot more focus and resources. And at the same time, they are quite active and kind of understanding the complexity of the transfer pricing audit in terms of the dual nature of one country once one country loses the budget revenue, and trying to resolve it with the international community. So at this point, I would stop and maybe see if Rudolf wants to add something or comment on something that I've just kind of showed and presented.
Thank you so much, Arnas. This does give us a clear view, isn't it, of the last decade on the major transfer pricing, say, data that you have presented to us. Question about content, perhaps. In the Netherlands, we see more and more that the tax authorities are making public to their taxpayers what kind of APAs and MAPs they are concluding. Is there any similar program in the UK as well, so that you can identify on which topics APAs or even MAPs are being concluded?
Off the top of my head, there's definitely some statistics about the parties, the other countries that are involved in MAP. Other than that, it's hard to guess. We have heard some big cases, but more on the audit side, in terms of financial transactions. So you can from let's say what you can get from public and let's say personal experience, it's still focused on financial transaction. It's still focused on more complex situations involving intangibles, management services and such. So couldn't comment on the very specifics of the MAPs agreed, because in that sense, HMRC is not as transparent as other jurisdictions, but generally kind of it would go the recently added chapters of OECD guidelines that are being explored and utilized. Let's put it that way.
Okay, thank you. For our audience, if you have a question, please do press the chat button on your screen. We will pick it up towards the end of our presentation. So for someone, Arnas, who has already found the button, question: you have shown us a chart about APA developments, number rising seemingly from 30 to 40. If it's seen well, do you perceive that as being going steady or on the rise? Or what is your take on that?
So if we go to the slide number 7, Rudolf, you could. It's an interesting one, but because I guess we all see the APA application bottomed out in 2017-18. I would not go as far as to say that it feels that there's a change of heart at the HMRC, because from my experience and the experience from other advisors in UK, it seems that if you want to show absolutely everything that you have on your files, then you can go for APA, and the HMRC might still take a look and couldn't make the decision. And remember, and maybe I will just indicate like this. So we don't, I don't see the big change. The governments have shifted. If we're thinking about the period after 2018, Brexit has been a lot more prominent. And the discussions about the attractiveness of UK came into forefront. So if you will look at the first half of this decade presented here, we can think about David Cameron and being, I would say tough but fair, but also very business friendly still, right? As the publicity around the sweetheart deals, there were some articles in the press on Apple, Starbucks, and companies like that, also echoed by the EU Competition Commission cases, state aid cases. There was a lot cautiousness with HMRC trying to agree, because nobody wanted to be perceived that they're not kind of giving it a good shake before agreeing. I think maybe those sentiments have been forgotten to some extent. We're talking the articles that had been released in 2012, 2013. So maybe what we see also that the very strict policy has been changed by Brexit. Namely, UK has to become more attractive to other bigger multinational businesses, and that's definitely was the goal of the government. There was a discussion about UK becoming the Singapore of Europe. So things like that might have also impacted, and maybe there is selective cases that do find it more comfortable to reach HMRC, but I couldn't confirm it from my personal experience. So let's see next year whether the applications go up or down.
Okay, thank you so much, Arnas. I think next chapter.
Yes. So as I said, UK kind of went out of the EU, and let's see what that meant. I'm sure you're also aware, so I'll try to be brief on this chapter. If we see the next slide, let's first talk about BEPS action plan. UK was at the forefront of this action plan. They always try to implement a lot of things even before there's a kind of a multinational consensus. And that was the case with country by country reporting. That was the case by diverted profit tax, which was kind of a take on a BEPS action plan, with the idea that, we're not sure if that BEPS action plan will be implemented. We're not sure if it will be kind of actionable, no pun intended. So diverted profit tax was a part of that. A lot of work of more complex tax arrangements, including the hybrids. That there was a new legislation that I know was a headache of a lot of my colleagues as well back in the day. MLI introduction again. UK, one of the leading countries on this. So you see a pattern of UK trying to be in the forefront of international tax discussion. Clearly, as we left the EU, they had to kind of compensate and say like, no, we're still international. We're still very much leading the discussion, and it was very much felt. Also, one maybe a smaller program, a smaller international initiatives of ICAP, but it's definitely an interesting one where I think there was even webinars on Quantera Global platform on the ICAP, but it's basically the voluntary discussions with by multinationals, by a number of tax authorities. So it might be 7, 10, maybe even 20 of jurisdictions talking to one multinational, one taxpayer as a group, and trying to agree on kind of their transfer model and making sure that all the 20 or 10 or 7 countries are happy with it. So it's also kind of just showing the UK is always wants to be in that first batch of changes on the international tax arena. In the next slide, we can just see kind of a bit more technical discussion about ATAD. I'm sure Rudolf could tell it a lot more because it is a EU directive.
It is,
So this was implemented around the Brexit times, you know, good old 2015, 2016, when it wasn't clear what's happening. So again, UK coming out of EU has done most of the tax-related EU initiatives, but they have done it in their own specific ways and with some tweaks as well. So in terms of the as an example, I can give also the example of DAC 6, where the rules were introduced in UK, but at the last minute, transfer pricing hallmarks were taken out of the DAC 6, and it became mandatory disclosure rules. So once introduced, UK is one of the countries that is really following through in applying and utilizing those new frameworks, and there was further tweaks in order to ensure that it's applied in the way it was designed. And I won't go through the kind of the details, but definitely a kind of attached to a large extent was applicable. Maybe one thing to mention about the general anti-abuse rules, there was quite a lot of discussions in UK whether that is needed or whether the, let's say, the common law approach of UK was sufficient to capture the, let's say, the general intention of the taxpayer to avoid taxes. It ended up being introduced as a double reasonableness test, and that is basically the HMRC would have to require or consider whether the arrangement cannot reasonably be regarded as a reasonable course of action, right? So the second part, reasonable course of action, is like business as usual, what you would expect the business to do for commercial reasons. And then there's the first part of that test is an objective observer of that situation has to reasonably conclude that was a reasonable course of action. So it's an interesting, very well refined approach, and it will take a bit of time to go through courts number of times in order to really understand how the rule could be applied. Some said that it's going too far. Some said it's going to be not applicable because of the complexity of it. But that's a good one to capture also for the transfer pricing audience, because it could also be applied for transfer pricing cases. So I think that's pretty much it. I want to go in terms of the international cooperation, unless Rudolf, you would want to add or something or ask some specific questions.
Well, thank you, Arnas. Indeed, very useful. A question about EU and OECD, perhaps in this lineup of thing. For instance, United States, although a member of OECD, does have its own peculiarities on transfer pricing. It has been for many decades and still is. OECD on the one hand and EU on the other hand are continuously pulling out measures, thoughts, but also a bit of guidance on how to deal with transfer pricing on an ongoing manner. More and more they are sort of closely following each other, so to say. With UK stepping out of EU, what do you think of UK's view on following OECD guidelines that may, to a certain extent, also have been pushed forward by the EU?
Yes, so that's a very good question. I would say, from my experience, and my clients have have a lot of operations outside of EU. I'm kind of actively involved in a lot of other jurisdictions in Europe, US, and Asia. I would say that UK, my perception of UK approach and HMRC approach is one of the most aligned with the OECD guidance, right? So they do always kind of happy to share their own interpretation of the rules, but the rules as well have a specific linkage to the OECD guidelines. And I think the way that UK sees it, they feel comfortable that they have enough of a voice within the OECD committees and actions. And I think that kind of eases the way of them saying, well, it's not the EU telling us things. It's OECD where we're a member and we're a very prominent member. So that's that. I would just maybe keep it short and say UK is very much aligned. And even, for instance, when you think about Chapter 10, the financial transactions in the guidance on financial transactions in OECD TP guidelines book, actually the UK rules on kind of borrower's capacity and the test from both sides, whether the borrower would have borrowed and whether a lender should have lent, kind of predates that chapter, right? So I think it's also learning both ways, and UK is really embracing that cooperation and sees OECD as one of the tools how to kind of have international standards applied to the letter in UK. You know, at the end of the day, courts will make some tweaks, but ultimately the rules are applied as written in the guidance.
Thank you so much, Arnas. Next one.
So maybe to kick things off on 2013, a quick recap of the spring budget, which was announced this year. The biggest, so in the next slide, you can see that the biggest change was the increase of corporation tax from 19 to 25 in the next, for the bigger taxpayers from the next year. Effectively, it's a change of policy because, you know, we kind of had the short-lived TAS's government, which tried to go the other direction, and the capital markets didn't like that. So we're trying second time going the opposite direction. The 25% is still on the very low end or lower end of the corporation tax rate in the G7, but it's definitely a high one for UK, and it will be interesting because if you remember all these transfer pricing yield numbers, that is all based on the not all, but to a large extent is based on the period when the corporation tax was lower. So this is an interesting development, and definitely might end up that the HMRC efforts to double down will be to double down on the transfer pricing audits, because all of a sudden it becomes a lot more lucrative, not lucrative, but better ROI, as they like to say, right? So so it's an interesting development, and from taxpayers' point of view, you know, again, UK will continuously emphasize the being open for business, but it's another element to consider in terms of setting up the headquarters and setting up the big operations that would be driving the profit from there. There's a bit about innovation. There's a bit about the patent box, which still is there and could be utilized, but it is a big increase when you think about it in corporation tax. I noted that there was one line in the budget about the abolition of the Office of Tax Simplification. I remember that Office of Tax Simplification also had a couple of initiatives about the transfer pricing. That office was abolished with the intention that HMRC will take the role of being a champion of tax simplification. I don't know if that's in their nature, but it's maybe a slightly disappointing element, because this institution and this part of the government were quite business friendly and were suggesting quite interesting simplifications, whether it would be the low value adding services or UK to UK transactions and things like that. And finally, one of the things that worth mentioning, it's more of a technical change, but automatic exchange of information regulations were consolidated. So you can see that, you know, the mandatory disclosure rules, which are the kind of DAC 6 equivalent, CRS, FATCA, CBCR, and kind of reporting on the digital platforms, all these regulations were compiled. And I think in order to streamline them from the legislative point of view, but I wonder if that also means that they are seeing the kind of the writing on the wall, that a lot more tax issues will be managed through kind of digital platforms in terms of kind of internal IT arrangements by the government and by HMRC. So, you know, you collect the data, you share the data with other jurisdictions automatically. So this is an interesting, maybe a sneak preview of you know, can we read from the leaves there? Maybe we can, maybe we can't, but something to watch out for, as we have also DAC type of regulations in the EU. I would imagine some more UK actions on this as well. So that's a bit about the general budget. Maybe we can go to the next slide and talk about the new documentation rules. Won't go in too deep. Again, maybe people have seen it has been in the news for quite a while. The consultation has been happening last year. There will be new transfer pricing documentation legislation. UK was one of the few countries that didn't have a kind of OECD type or local specific type of documentation requirements, right? So they have introduced country by country reporting from the BEPS, but they stopped short of the master file local file requirements. Now they are introducing these requirements, but again from very high threshold of 750 million. Which is the same threshold as applies for the CBCR. The new regulations applies for the financial year starting after April 2023. And again, this is something that ties into the idea that HMRC wants to focus on big ticket items, right? So if they have a lot more information about the multinationals operating in the UK, that kind of also helps them to risk assess and focus on the challenges on the very material transactions. That being said, I think that it's also important to emphasize that a lot of taxpayers in the UK have had documentation prepared in maybe a bit more looser form. Some of them, they still follow the local file master file concept and framework, just because they would have international operations anyways. It just makes sense to use the same OECD kind of framework. So nothing, you know, is there a lot of taxpayers over 750 million that do not have UK legislation, UK documentation? Maybe there's a few, but not too much. And even on the lower side, the previous requirements included kind of ability to prove that you have taken care on your transfer pricing arrangements, and kind of it's almost easier to prepare something which is resembling a local file or TP documentation than to kind of have a guesswork of what is enough in order to show that you have had advice, if it's material, have looked at it, and have applied the transfer pricing rules as you should have. So that's kind of the change in visual, maybe not as much change in terms of preparation. I think now also this kind of clarity of what kind of format to prepare for UK as a jurisdiction. There are some specificities, and one of the specificities that were discussed was this SAT, Summary Audit Trail. Effectively a checklist a taxpayer should provide answers to that they have taken necessary steps in order to kind of have a good quality TP documentation. So this was not accepted in the current legislation, but there is definitely a continued interest in this from the government side. And I think realistically, it shows the element of it's not only the tax authorities, HMRC, not only are interested in the final document, but also interested in the way it was prepared in order to, again, assess whether you have kind of taken reasonable care, or is it just something, a document slapped together in the last minute. But also an indication that as we're going more digital, as we're kind of sharing more data, part of that data will be kind of the action and procedures the company is following. So that's an interesting development, which I think could also be introduced in some other countries as well. In the next slide, maybe let's talk about very technical things, what they have changed in order to enable the transfer pricing documentation rules. First of all, HMRC will be able to request the transfer pricing documentation without a formal inquiry, without kind of the audit procedures being started, which means, you know, a lot more ability for HMRC just to keep sending emails to the taxpayers and saying, like, send us the documentation, please, instead of trying to start a big process or being, you know, you have to have a reason why you would start a formal acquiring. There has to be some sort of like risk being flagged, whether through the algorithm or by people looking at your numbers and the evidence. In this case, the starting point can be that email asking for documentation, and then they can look around, risk assess, and launch a formal inquiry as a tax audit. And then the final point on the right side of the slide, the penalties will not be based on some sort of absolute amount. It would be introduced within the general corporation tax penalty system, where they risk, or not risk assess, or assess the behavior of the taxpayer, whether it's careless, whether it's deliberate, whether it's deliberate and concealed, and assess those categories in order to say whether it's 30% penalty on the tax adjustment, you know, the adjustment and the tax which ends up with the tax loss, so the tax loss amount for the government, and 30% of that is a starting point, and it goes all the way to 100 or 200 in some specific cases. So again, if you are not compliant with the documentation requirements, if you can't prove that you have kind of taken reasonable care and showed and presented the documentation in the right time frame, then you would be facing the penalties on the tax adjustment as well. I think if we can move to the let's say final slide for the future developments, the Pillar 2. I'm sure that a lot of people on this call know the specificities of Pillar 2, so I won't go too much into the details of that. But effectively, it is a OECD launched initiative to almost kind of coming from the BEPS action points action plan, and it's taking a long time to get to a place where the international community and the key jurisdictions agreed to introduce Pillar 2. It basically says that there is a global tax minimum for corporate profits of 15%. Any big multinational should pay at least that, right? And if one jurisdiction chooses not to tax a certain amount, chooses to tax it at a lower rate, then those companies, those jurisdictions that participated in this Pillar 2 framework would be able to tax the local headquarter, the local entity that is a headquarter, or an entity that is on the other side of of a related party transaction, for instance, and have a top-up tax being paid in that jurisdictions instead of the one that is choosing not to tax it or tax it at a lower rate. There's some dates on the introduction of it, so it will start applying from the next calendar year, or the accounting periods that start in the next calendar year, and there will still be a lot of nitty-gritty to figure out in terms of the way that will be applied. Again, UK was one of the first jurisdictions that introduced and offered to kind of the rules and draft rules for consultations, and in some ways they even kind of preempted OECD in some cases, saying like, well, we think that it will be introduced and will be calculated this way, but there's a lot more detail to be figured out in the months and years to come. So I think I would stop at there in terms of the main developments and a bit of like a looking into the future on the UK. I don't know, Rudolf, should I just cover the key takeaways very quickly, and we go maybe 1-2 questions, or is there something additionally that you would want to highlight there?
I think this is sharp and clear altogether. Quite some content in just one slide, so to say, Arnas, but there's quite something to discover indeed. Pillar 2, you just addressed, and that goes way beyond the capacity of this very call. It does, but indeed it does vary quite a few listeners to this very call. What would be the if at all the position of the UK government in 2 years' time, when the first books will be opened around Pillar 2? What do you perceive? A bit of, say, classic style UK, well, first year event, let's take it lightly, so to say, or do you think that they will be more strict, more, say, EU-centric, I guess?
So as with all international rules, I think what is useful and helpful for any UK taxpayer is that government spends a lot of time and a lot of effort in order to communicate the rules and in order to try to address as much as possible, whether in the legislation as well or in guidance. The legislation might not be very clear, but there's guidance as well in terms of how you should interpret it. Also, there's an effort on making it easy for the taxpayer to be kind of compliant with the rules. And as a very silly example, but I can say, like even CBCR initially was being reported by email, and there were things that they would say, oh, let's just solve it practically and make it easy for people to comply, instead of making it super complicated. So I think in terms of the implementations, they will explain it, what it means. They will help to implement it, but ultimately, I think that HMRC will expect everybody to follow through. I mean, it's definitely a bit of formulaic approach on things to some extent, and that if the formulas are saying certain things, that they should be followed, right? And assuming there will be a digital solution for it, I think it's going to be quite easy to see if the formulas were not, I mean, using the, again, kind of algorithm and IT solutions to flag the non-complying taxpayers. And I think those non-compliant taxpayers can expect an email or a call from HMRC swiftly. So I would imagine that implementation will be to some extent EU style. It has to be done and it has to be followed.
Okay, thank you. Any?
Yeah, maybe final thoughts, because I want to kind of reiterate everything, but seems like HMRC becomes aggressive. Seems like they're pushing a bit on the taxpayer to self-assess in the rules, like DPT in diverted profit diversion facility. They have hired a lot more people. They are investing in the digital solutions. They are very much in line and at the forefront of the international tax frameworks, and also taking steps to kind of bridge the gap where they were, let's say, a bit behind in terms of like the transfer pricing documentation, master file, local files. I think practically what it means, and also like just to mention that again, that summary or audit trail element, I think what practically it means that if the HMRC is investing into the processes and solutions, so should be the taxpayers. I mean, I'm sure you see it in your practice, and it's one of the ideas behind the new brand we're launching, IVC Consultancy, kind of the automation, ensuring that the audit trail is captured, ensuring that there's the right way of dealing with the information and documents. So like all these elements practically means has to be kind of also investment from the taxpayer side. Otherwise, you will fall behind, and you don't want to tax authorities to be outgunning you in terms of the IT solutions, because you'll be kind of a sitting duck to a large extent. So and you know, whether it's automatic reporting or it's the CBCR or it's the new legislations that to come, I think it all points to one direction, that we do have to think about it strategically, not to look at like, okay, do we have to document UK operations for master file, local file, but also the wider picture of how the organization is doing that. How are we ready for coming HMRC coming to us and maybe knowing about us a lot more than before?
Thank you very much, Arnas. I think if I'm right, we have one additional question that came in. I think you have discussed this along the way to a certain extent, but question is still addressed, I guess, Arnas. Turnover of our organization is below 750 million. Would it still be required or useful to maintain basic transfer pricing documentation?
Rudolf, do you want a one-word answer in this one?
Yeah.
Yes, but
yes, answers yes. Yeah.
To be serious, I mean, even a lot of our clients are below 750 million, right? Not, we have bigger ones, but like there's a lot where you still do the documentation as noted, and you should have those documentations, because it's easier, almost easier to make that marginal additional investment in kind of covering UK in addition to all other countries, as opposed to kind of leave it hanging, because even if you are not required to have the documentation, HMRC has so much at its disposal, so many tools, so many weapons at their disposals, that you don't want to be caught off guard. Especially, you know, I mentioned profit diversion compliance facility. Imagine you don't have a documentation of your transfer pricing operations, and you get a nudge letter from HMRC saying, we see you, you've been flagged, you're non-compliant, please give us the additional tax revenue, right? What do you do? And then you haven't even gotten the overview of what is happening in UK. So the answer is yes, for sure.
Yeah. Thank you so much. Ladies and gentlemen, this brings us towards the end of our webinar of today. Thank you so much for being with us. Upcoming webinars noted on this very slide. 10 years webinar on how to grow your business utilizing transfer pricing automation, and then 3 country webinars again, like this one, on Germany, on Poland and the US. More coming up after mid of July still. Arnas, perhaps a final thought from your end at this point.
I will just apologize for taking on the whole hour talking about this, but it was ambitious to take less than an hour for 10 years of very much active developments on the transfer pricing and tax in the UK. So it was too ambitious to fit in less than an hour, but hopefully people enjoyed it and found it useful. Thank you.
Thank you, Arnas. Thank you, listeners, and hopefully till next time. Bye-bye.
Thank you. Bye-bye.